Okay, so here are some situations. You live with your 5-year-old son, Mike, and Mike's other parent also lives with you. You and the other parent are not married. Mike is qualifying child for both of you. He meets the joint return. He's only 5, so he's not married. He's under 19. He's related to both of you, and he lives with both of you. So both of you have a valid claim to claim Mike. But because of the tiebreaker test, since you're both his parent, then you can decide which one of you is going to claim Mike, as long as you both agree. If you don't both agree, then it's going to be based on the number of days Mike lived with each of you. Well, you live together all year, so it's going to be the entire year, all 365 or 366 days. Then you're going to have to fall back on the adjusted gross income rule, which, if your earned income is only $12,000 and the other parent's earned income is $14,000, then the other parent will be the one to claim Mike. But remember, you can choose this rule. This part of the tiebreaker rule only applies if you don't choose. And you would have to use all of the tax benefits. So not just earned income credit, but whoever claims Mike would also claim head of household filing status, child tax credit, and child dependent care benefits. But remember, for head of household filing purposes, you also have to pay more than half the cost of keeping up the home. So if the parent who only made $12,000, it makes sense that if they have the lower income, they might pay a little bit less than half the cost of keeping up the home. If it was exactly 50-50, they exactly split the bills, and nobody's paying more than half the cost, and technically neither one could be head of household. And you can't have more than one head of household in the same family. So maybe in this example, the unmarried parents have 2 children, and it's probably best for each of them to claim one child. Not necessarily, but most likely. But only one of them could be head of household. And it would probably be the Sam in this example who made 14,000 as opposed to year 12.
TV went black for a minute.
Okay. So because both parents lived in the same home, you can't use 8332. 8332 is only used in the case of divorced or separated parents. Okay, here's our second example. You and Bob and Joey. So you are the taxpayer, Bob is your husband, and you have a 10-year-old son, Joey. You live together until August, and then Bob moves out. In August and September, Joey lived with you, and then for October, November, and December, Joey lived with Bob. Joey meets all the tests for both of you. So for the you in this example, Joey lived with you from January through September, which is 9 months. And for Bob, Joey lived with him from January through July, which is 7 months, and also October, November, December, which makes it 10 months. So Joey lived with each of you more than half of the year. So because he meets all the requirements for both of you, again, the parents can choose who's going to claim Joey as dependent. If they don't choose, if they don't agree, or they both try to claim Joey, then we're going to fall back to whoever the child lived with more than the other parent. And in this case, it's going to be Bob because he has 10 months and you only have 9 months. However, in this case, if you don't file a joint return, so these two parents are still married. So it's going to turn out that nobody can claim earned income credit. They can choose who claims them as dependent, but they can't claim earned income credit because they live together some part of the last 6 months of the year, specifically July 1st through August 1st.
So neither of them can claim that.
Right. So they can choose who's a dependent, they'll get child tax credit, but they won't get earned income credit unless they file a joint return, which might be worth, with one qualifying child, that might be worth $3,000 or $4,000. So they, even if they're not talking to each other and they hate each other's guts, they might find a way to file a joint return. And we do that sometimes. Maybe one parent will come in Monday, the second parent will come in Tuesday, they drop off their stuff, and the first parent comes back and signs on Wednesday, and the second parent comes back and signs on Thursday, so they don't have to see each other. And then there's a way to split up. Someone's refunded to two different bank accounts, so we could say, they might say, just give us each half, and that way we don't have to negotiate or send each other a check or nothing. Or just send it to our lawyer. Okay, we talked already about Schedule EIC, and we talked about the Form 88. Was it 86 or 88?
8862.
Yeah, 8862. Thank you. Okay, so again, a quick summary. You must have earned income. You must have a valid Social Security number. Your spouse must have a valid Social Security number. If you're married filing separately, you cannot live with your spouse even one day during the last 6 months of the year. You cannot be a non-resident alien any part of the year. You cannot be a qualifying child of any other person. You can't exclude any foreign earned income. And your investment income must be below a certain limit, which was $11,000 in 2023. The most common errors in claiming earned income credit, and this is errors that taxpayers make when they're doing their own taxes, and these are errors that professionals make when they're doing taxes for someone else. The most common errors are claiming a child incorrectly. A child only lived with you 5 months out of the year. Well, they're not your qualifying child. Next most common is you're married, but you file as single or head of household. Well, if you're married, you can still file head of household. Remember the rules for being considered unmarried. But if you're married, you absolutely cannot file as single. And that's, that can be a temptation. If you're married filing separately and your spouse lived with you part of the year, last 6 months of the year, and you prepare your taxes and you don't get any earned income credit, it's a temptation to lie on your tax return and say, oh, well, put single instead. Then your third most common error is reporting the wrong amount of income. Like you worked 3 jobs last year, but you forgot about the third one because you only worked there 1 week, or maybe you worked until December the previous year, but you got a paycheck in January, which means you would get a W-2. So you reported the wrong amount of income. And the fourth most common error is you misremembered your kid's Social Security number, or you wrote it down and your taxpayer couldn't read it and typed it in. Also, fairly common, but not in the top 4, is getting your kid's name wrong. You might think that's pretty odd, but if you've recently adopted your children, their legal name it might not match their Social Security records yet. And on the tax return, it's got to be whatever the IRS thinks their name is, which is going to be the same as what Social Security thinks your name is. So if you recently adopted your child and got their last name changed, but you haven't informed Social Security yet, then you're going to have to use their old name when filing tax return.
And that can be a headache.
Yeah.
That's cute. That's right. 4 times before you have to make right.
Yeah, as far as I know, it can take 4 to 6 months for Social Security to actually do anything if you ask them to.
Yeah, somebody at the door. It's ASRC. Can I get in?
Yeah.
Oh,
Yeah,
okay.
they work upstairs.
Sorry, I wasn't sure.
You might also get, or maybe your tax preparer will get your kid's name wrong if they have hyphenated last name or if they have multiple middle names and multiple last names. But usually on the Social Security card itself, there's one line that's the first name and all the middle names, and the second line is all of the last names.